When you picture your financial future right now, what do you see? A calm, predictable path to the life you want, or a storm of headlines, rate hikes, market bubbles, and constant worry about whether your money will still be enough 5 or 10 years from now? If you're honest, you're probably feeling at least some of that uncertainty. You're not alone. Over the past few years, we've lived through one of the most chaotic interest rate cycles in modern history. Rates went from near zero to multi-decade highs in record time. That single shift flipped the entire bond market on its head and left millions of investors confused about where to find both safety and income. And yet, inside this chaos, something extraordinary has appeared. A genuine anomaly. An anomaly where bonds from some of the strongest, most stable companies in the world are trading at distressed prices, while their underlying businesses remain incredibly healthy. That's the heart of the opportunity you're about to hear, and it's exactly why the Credit Cashflow Investor service exists. So, what is really going on out there? When interest rates were pinned near zero, long-term corporate bonds from blue-chip businesses routinely traded at or above their 1,000 face value because they were one of the only ways to lock in 5% plus income for years at a time. Then short-term US Treasuries suddenly started paying similar yields. For many investors, the choice seemed obvious. Same income, less perceived risk, shorter time commitment. They fled into short-term debt, and, in the process, they pushed prices on longer-term corporate bonds sharply lower, even though the quality of the companies issuing those bonds didn't suddenly collapse. Today, that stampede has left a strange landscape. You can find bonds issued by household name companies, global brands with robust cash flows, trading for 70, 65, even under 60 cents on the dollar. Not because these businesses look like they're going under, but because the math of the market was forced to adjust at high speed. Now we're standing at the beginning of the next phase, a rate-cutting cycle. Central banks have already begun easing off the brake. Analysts expect more cuts through 2026 as inflation moderates and growth becomes the focus again. And here's where bond math turns from a problem into an opportunity. When new rates fall, existing bonds with higher locked-in coupons become more valuable. Their prices rise, often dramatically, especially if they were heavily discounted in the first place. So if you can identify solid, mispriced bonds now, while fear and confusion are still in the air, you position yourself in front of that move. That's exactly what Credit Cashflow Investor is built to do. Credit Cashflow Investor is an income-focused research service from Altimetry, led by Chief Investment Officer Joel Litman and Director of Research Rob Spivey. Their specialty is simple to describe, but difficult to execute. They search the universe of junk-rated or unfairly discounted bonds and ask one critical question: is this bond truly risky, or is the market just mispricing it? They use a framework called uniform accounting to strip out distortions in traditional financial statements and model a company's real cash flows and obligations with far greater clarity. They look at how much cash the business generates, how its assets support its debt, and whether it realistically can and will pay bondholders back in full. If the answer is yes, if the company is far healthier than its bond price suggests, those are the opportunities they bring to Credit Cashflow Investor readers. Altimetry describes the service this way. It specializes in uncovering hidden value in bonds rated as extremely speculative or non-investment grade by Moody's, Fitch, and S&P, and pinpoints low-risk bonds with high cash flow potential, poised to move higher as the market re-rates them. In plain English, they look for strong companies whose bonds are trading like junk, even though the underlying credit story is anything but junk. Let's talk about what that looks like in your life as an investor. Imagine you buy a bond from a well-known, cash-rich company. When it was first issued, it was priced at $1,000. Today, because of the rate shock, it trades at $650. From that moment, two powerful engines start working for you. First, the income engine. The coupon you're owed each year is fixed in dollars by contract. If the bond pays $50 a year, that doesn't change. But at a $650 purchase price, that same $50 suddenly becomes a yield of around 7.7%. Often, several times the income you'd get from blue-chip dividends or a savings account. Second, the repricing engine. If rates fall and fear fades, and that bond simply trades back toward its original $1,000 value, you're looking at roughly 54% capital gains, before even counting the income you collected along the way. That's how bonds can deliver stock-like returns with a very different risk profile. You're not relying on endless growth or market hype. You're relying on a legal promise to pay and the normalization of an abnormal price. Credit Cashflow Investor exists to help you find those very specific situations. Not just any high-yield bond, not just a list of ticker symbols, but a curated set of ideas where the team believes the business is fundamentally strong, the bond is mispriced because of macro fear or blanket selling, and the current yield and potential upside justify the risk. Let's be clear, no strategy is risk-free. Corporate bonds still face credit risk. Interest rate cuts could be slower or shallower than expected. The market could stay irrational longer than any of us would like. But here's what you gain when you adopt a credit-first mindset. With a service like Credit Cashflow Investor, you stop guessing, you stop treating bonds as an afterthought, and you start deliberately using the fixed income side of your portfolio as a port in the storm, a place designed to produce cash flow and potential price appreciation, even in a messy, political, late-cycle world. You can still own stocks, you can still pursue growth on the equity side, but you don't have to stake your entire future on the most volatile part of the market. Instead, you build what professional investors call a barbell. On one side, carefully chosen, mispriced bonds identified by deep credit work. On the other, a targeted selection of high-quality stocks. Together they give you balance, they give you resilience, and, done well, they can give you the potential to grow your wealth and your income without losing sleep every time the headlines turn ugly. So, here's the question I want you to sit with. If there truly is a short window where blue-chip quality bonds are still trading like distressed junk, if a rate-cutting cycle is already taking shape, and if you could stand on the same side of that trade as seasoned credit analysts who live and breathe this market every day, do you want to stand on the sidelines, or do you at least want to understand the play? If your answer is, I want to understand it, then your next step is simple. Click the link in the description and take a closer look at Credit Cashflow Investor. There, you'll see how Joel Litman and Rob Spivey source ideas, how they evaluate risk, and what kinds of bonds they're focusing on in this rare environment. Read the details. Study a few examples. Decide for yourself if this approach belongs in your toolkit. Because opportunities where mispriced, high-quality bonds can potentially deliver equity-like returns do not come around every year. They emerge when the world is off balance, when fear and policy shocks create distortions that careful investors can turn into long-term advantages. That's where we are right now. And that's what Credit Cashflow Investor is built to help you capture. If you're ready to turn this turbulent market into a genuine opportunity for income, stability, and growth, click through, learn more, see now, and the desiree number, and then scan number, see this strategy, but is right for you.